Somewhere ahead, maybe in a few years, 5 years, 10 years, I believe the price of gold will cross the price of the Dow. That will be at a time when sentiment toward gold in the market will have done a complete switch. That will be at a time when instead of paying near 30 times earnings for the Dow, bearish and discouraged investors will pay 5 or 7 or maybe 10 times earnings for the Dow. That will be a time when gold will be loved, and there will be probably a worldwide frenzy to own gold. The gold shares will rise in harmony with the metal. When will that happen? And my answer is that I don't know. But I do know this: investors are currently far too optimistic about the future. Why do I say that? Because stocks are selling at higher price-earnings ratios than at any bull market peak in U.S. history. At the same time, gold is selling at less than half its peak 1980 price. This after 23 years of loss of purchasing power and after a 19-year bear market in gold. That's my position. I don't have any debt. I've been through it all. Bull markets and bear markets, war and peace, depressions and booms, conservative markets and frenzied markets. And that's my story. When the ancient Chinese wise man was asked for one sentence that would fit all situations, he answered, "This too shall pass." He was a wise man. A story. Here's a crazy thought that came to me. You're standing in front of your home. A guy drives up in a Mercedes, steps out, and asks you how much you want for your house. You don't want to sell your home, so you give him a phony price. You smile sheepishly. "Geez, I guess I'd take $6 million for the house." "Sold," says the fellow. Without another word, the guy goes to his car and pulls out a portable table and a funny little machine. He plops the machine on top of the table. Why, it's a printer, and a high-speed printer at that. The guy presses a button, there's a whirring noise, and out comes a stream of $100 bills. And I mean, this machine is super high speed. In 10 minutes, there's a huge pile of $100 bills sitting next to the machine. "Never mind counting them," says the fellow. "My printer is always right. There you are, my friend, $6 million in dollars. And I'd really like to move into your house within 30 days. Question: is this guy just a proxy for the Fed? And is this pretty much the situation that we have today? But wait, you tell this fellow, "Hey, I wasn't talking about paper dollars. I want $6 million in gold for my house." With that, the fellow picks up his printer and table and puts them back in his car. Then he turns around and snarls, "Next time, say what you mean. $6 million in gold? Are you nuts? I don't have no stinking machine to make gold." Russell comment: "Sorry, excuse me, I sometimes have these crazy fantasies." Where are we? World overproduction? You don't believe it? In the Financial Times, I see an article with a headline, "Global Unemployment Hits Record High." The article begins, "Unemployment worldwide edged up to a record 185 million last year, despite higher global growth." Then in the Wall Street Journal front page, I read, "The gap in wages is growing again for U.S. workers. Inequality is seen as a result of the jobless recovery. Potential election theme." So, what's happening is the U.S. is losing its middle class. The trend is that you're either in the wealthier economic class and making good money, or you've lost your good middle class job and now you're parking cars or mixing martinis at your neighborhood bar. So the forces of world overproduction and deflation are at work, but so is the Fed. After a long string of losses in the broad M3 money supply, 2 weeks ago M3 surged $30 billion. And the latest figure for the week ended January 12th, M3 shot up a monster $37 billion. The Fed, it seems, has decided to go all out, preparatory to the November election. Greenspan has taken the lid off the M3 money supply, And the word, I assume, is let it rip. As an aside, 2 weeks of this kind of money supply growth would buy all the gold stocks in existence. But what worries me is that the bear market is not finished. The bear is only giving us a reprieve. And the longer the bear market is held off, the angrier the bear will be when he decides to attack again. So what do we do about it? I think we have to develop a psychological mindset. During the later years of the Great Depression, there was a daily cartoon, I think it was in the New York Telegram, entitled Grin and Bear It. It was about this guy who always faced a new problem, but somehow he would just grin and bear it. What I see coming up is not going to be pretty, so we'll do the best we can and just grin and bear it. First problem, we probably have most of our assets in dollars. That's okay as long as the dollar declines slowly, as it has been doing. Nevertheless, in the eyes of a lot of the rest of the world, we've already been losing money. How come? In January 2002, the dollar index stood at a high of 120. Today, the dollar index is trading just over 86. That represents a loss of 28%. Whatever we own in dollars, which is probably just about everything, is down 28% if you're a European or in a strong currency. Australia, New Zealand, Canada, even the pound. So far, the decline in the dollar, although deep, has been slow and polite. The big worry would be a world panic out of dollars. A dollar panic would run interest rates up in the U.S., and this in turn would impact our monster mountain of debt. If that happens, well, I don't even want to think about it. So again, what do? My only answer is diversify. By diversifying, we can only be partly wrong. Remember, in a primary bear market, everybody loses, and the winner loses the least. We are all mainly in dollars because everything we own is denominated in dollars. Our house, our business, our salaries, etc. We can diversify into euros, which I've recommended via the German notes. We can diversify into gold and gold stocks and into silver and silver stocks. I've listed a group of closed-end funds, and so far the group has done well. This group includes funds that hold foreign bonds, foreign stocks, Asian stocks, emerging market stocks. I just went through my list of closed-end funds. They are traded just like any other stock, and the following candidates are worth looking into: EMF, GIM, FCO, FAX, RCS. You can check out the charts of each on bigcharts.com. Since last September, bonds have done well. How can this be with the dollar declining? The answer is that Japan and China have created huge amounts of money as they move to buy dollars. They buy dollars in an effort to keep the dollar higher against their own currencies, which of course they want lower. This is the competitive devaluation that I've been talking about. And with the dollars they buy, they turn around and invest those dollars in U.S. treasuries. And that's the secret, why the T-bonds have advanced even while the dollar has declined. And of course, the wide yield curve has helped. Take a chance, borrow at 1% and buy bonds that yield 4 to 5%. It's a great game while it lasts. The banks love it, and they always have. By keeping short rates at 1%, Greenspan literally feeds profits into the banks and the whole financial system. Of course, the problem is that by keeping short rates artificially at 1%, Greenspan has built the greatest debt edifice in U.S. history. Deflation is the deadly enemy of high debt, and that's going to be a mighty problem that's going to come up once the bear market resumes. So what the Greenspan policy has done is put the U.S. in a position where it must generate rising inflation. Thus, we go back to what I warned about back in 1999. It is inflate or die.